Today, I wanted to go over a weekly recap of the market based on the data and the news which came out throughout the week. Based on the data and the news, I'll try to make a prediction on how the market will move in the short to mid-term. So first on the data, core data that came out this week include month-over-month CPI, year-on-year CPI, month-over-month core CPI, and year-on-year core CPI. And there was also crude oil inventories that was announced and a rate cut decision by Bank of Canada. Now let's look at the data one by one. On December 11th, 2024, Consumer Price Index came out for the month of November. If you look at this table, month-over-month CPI increased by 0.3%, which is higher than the previous months, which was mostly standing at 0.2%. If you look at this on a year-over-year basis, it's at 2.7%. Now the numbers are generally in the range of expectations, but the increasing trend, which is shown in recent months, is quite worrying. If you look at the trend from September, all items line is showing an increasing trend up until November, which means that inflation is still quite sticky and lingering in the market. Now let's look at it on an item by item level. If you look at this table, we can get a sense of the overall CPI trend in November. As you can see here, November month-over-month CPI, basically how much the prices have gone up versus October shows a 0.3% increase. And on a year-over-year basis, it translates to 2.7%. Month-over-month core CPI, which is basically a CPI excluding food and energy, was at 0.3% on a month-over-month basis and 3.3% on a year-over-year basis. Now, while both CPI and core CPI measures are important, core CPI can be deemed more important because it removes volatile items like food and energy and provides a more stable measure of inflation trends, which helps the central bank design future policies to achieve a target inflation rate. So if you look at the numbers, the reason both CPI and core CPI are showing high numbers is because of this item right here, which is services less energy services. The item mainly consists of shelter, which is basically housing price, transportation services, and medical care services. Now this is extremely important because out of all the items in the CPI, shelter and services are the items which impacts every bit of our life, leading to a decrease in people's consumption power. For example, you can always choose to eat cheaper food, take public transportation rather than driving a car, decide not to buy new clothes, but every single person needs a place to live, whether it's owning a house or paying rent. Now if this inevitable cost increases, it'll naturally lead to saving costs from other areas of less importance, which will cool down the overall economy. But even if the economy is cooled down, the inflation will continue to remain above the Federal Reserve's target level, leading to a big challenge in decreasing the interest rate. The Federal Reserve's target CPI is currently at around 2%, which means that the Fed will do something, either slowing the interest rate cut or decreasing the Federal Reserve balance sheet to lower the inflation to their target level. The inflation rate has been extremely sticky and not going down further than at around 2.5 to 3.5%, which poses a real challenge for the Federal Reserve. I think this will continue to be the case in the midterm unless a big correction in the housing market happens, leading to a decrease in the overall rent and housing prices. Also, US wholesale price data also showed an above expectation level, which is a big concern as well. Next major data that was announced was the crude oil inventories. Now, for 3 weeks straight, crude oil inventories was decreasing, which means that oil is now becoming more and more scarce in the US. The oil inventory decreased by around 1.8 million barrels in the last week of November, and last week it decreased by 5 million, and this week it decreased by 1.4 million. This is actually a pretty significant streak in the drop of oil barrels, as it consistently exceeded the expectations, which only showed around 1 to 1.6 million barrels of oil decreasing week over week. Interesting thing here is that if you look at this chart, the price of oil has actually been very stable within the band of $65 to $75 in the past 4 months. Personally, I actually think this is really due to the overall economic downturn, including China, which is leading to less demand of oil to run factories or conduct economic activities, and also OPEC plus countries manipulating the oil prices by producing more oil for their own interest to fund their national budgets. I think oil price would need to demonstrate a stable increasing trend for us to confirm that the economic activities are back in action, but as of today, that is not the case. Next is the Bank of Canada rate cut. On December 11th, Bank of Canada announced a 50 basis point rate cut, cutting the overnight rate from 3.75% to 3.25%. Now, this is the 2 consecutive 50 basis point rate cuts in a row, but they did signal a slower pace of rate cuts moving forward. Now, Canada is going through a difficult economic phase where unemployment rate continues to rise. Canada's inflation rate is relatively controlled at around 2%. However, from my perspective, this inflation is not because the economy is stabilizing, but this is really because of the economy which is suffering, leading to less consumption power from the people. Therefore, this rate cut is really to boost the market sentiment to revitalize the falling economy rather than celebrating the cool down inflation. Now let's move on to some commentaries on the market based on what happened during the week. Market was generally mixed during the week, with S&P going down by around 0.64% and Nasdaq rising by about 0.34%. The reason for the movements was mainly due to the inflation data being in the range of expectations, which shows that the market is really trying to keep the positive momentum and trying to find excuses to continue to rise. But the following wholesale price data imposing concerns on the interest rate cut. The positive movement in the index was mainly led by tech and growth stocks such as Meta and Tesla. Now, this is quite worrisome, as this really solidifies the thesis that the market is desperately finding excuses to continue to go up and push the overvalued stocks even higher. Now, finally, let's take a look at the Federal Reserve policy table to get a sense of where we are. While we're currently in Section C, with all the data that came out this week, we can confirm that the inflation is still lingering, led by the rise in shelter and services prices, which puts a higher pressure for the Fed to shift towards Section D. However, stable oil price and Bank of Canada's rate cut may somewhat offset the speed of the Fed's movement towards Section D, meaning that we may stay in the range of Section C for a little longer. That said, I think the market is pricing in the potential 25 basis point rate cut, which is potentially taking place this month. And once that is completed, with Trump's inauguration and additional tariffs being applied on goods, the Fed will have to inevitably slowly move towards Section D. I think that will happen over the course of the next 6 months, so money will slowly flow from tech stocks such as Nvidia and Tesla towards more defensive stocks such as pharmaceuticals and financial institutions in the next few months. One caveat here though, I don't think we can say with 100% certainty that the rate cut will happen this month. If it doesn't happen, there will be volatility in the market, and we'll see. So for those of you who are holding tech and growth stocks, you may want to consider slowly shifting towards defensive stocks and prepare for the world heading into Section D in the midterm. I'll be back with another set of market update next week. Let's review the data and the news which came out throughout the week. Based on the data and the news, I'll try to make a prediction on how the market will move in the short to mid-term. Now, first on the data. Core data that came out this week include November retail sales, Federal Reserve rate cut decision, initial jobless claims, Bank of Japan's rate decision, existing home sales data, and core PCE data. Now let's look at the key data one by one. On December 17th, US retail sales data came out for the month of November. If you look at this table, month-over-month retail sales was at 0.7%, which was slightly higher compared to the consensus, which was at 0.6%. It was also higher compared to the previous months, which was at 0.5%. On the other hand, core retail sales, which is retail sales excluding automobiles, rose by 0.2%, which was lower than 0.4% forecast and in line compared to the previous month. Now, what this means is that the consumers in the US are still enjoying their consumption power and still purchasing goods on a daily basis, despite the Federal Reserve's efforts to cool down the inflation. Public demand during the difficult economic times may be good for the companies, but for the economy as a whole, the demand needs to significantly cool down in order for the Federal Reserve to be in a comfortable position to continue to lower the interest rate. I'm going to get to the Fed's interest rate decision later on in the video, but strong retail sales was a prelude to the Federal Reserve making an announcement to slow the interest rate cut in the future. Now let's move on to the Federal Reserve rate cut decision. As I noted in the market update last week, the Federal Reserve did lower the interest rate by 25 basis points, as you can see in the table. However, Jerome Powell said, quote unquote, "We've been moving sideways on 12-month inflation, and the move to cut rates in recent months allows the Federal Reserve to be more cautious and reconsider more adjustments to our policy rate." What this means is that given the sticky inflation, the Federal Reserve will inevitably have to slow the lowering of the interest rate significantly until the inflation shows a meaningful cool down. Now, as I said multiple times in my previous videos, this was an obvious outcome. I mean, didn't everybody monitor the CPI, core CPI, the PPI, the retail sales? The data was indicating a sticky inflation for months, and I've been saying it for months. I just don't understand why all investors and the market were betting on the market going higher and higher, ignoring the data that was coming out every month. Now, based on the rate cut decision that came out, the market is now expecting the rate to be held constant in January at 4.25 to 4.5%. This is a big shift from the previous projections, where the market expected the rate to continue to go down throughout the course of next year. It is not only that, but if you look at this table, by the end of the next year, the market is assuming that there's an over 80% chance of the federal funds rate staying above 3.75 to 4.0% level, which means that at maximum, they're expecting that there will be only 2 rate cuts or less throughout the entire year. Now, this basically means that the market is finally extremely wary of inflation and expects the Fed to take necessary measures by slowing the interest rate cuts in the months to come. Another data which came out was negative as well. The initial jobless claims came out for the week, and this data represents how many people actually lost their jobs and applied for initial jobless claims. Higher the number means that the economy is weak, and a lower number means that the economy is strong. If the economy is weak, the Federal Reserve has more means to boost the economy by lowering the rate, but if the economy is strong, the Federal Reserve has less incentive to lower the rate. If you look at this table, the initial jobless claims stood at 220,000, which was lower than the forecast and much lower than last week. So given the low jobless number, it means that the economy is doing fine, which means that the inflation will either stay or strengthen, which means that the Federal Reserve will most likely slow the interest rate cut. Next data that came out is Bank of Japan's interest rate decision. BOJ kept its interest rate flat at 0.25%. However, some hawkish members of the committee suggested that raising the rate to 0.5%, reflecting concerns on the inflation as well as uncertainties around Donald Trump's inauguration and the associated tariff plans. As a result, while the interest rate was kept flat, they also signaled that the rate cut will be slowed, which impacted the overall Asia market. Now, moving on to the next data, existing home sales data for November came out on Thursday, showing a 4.15 million sales, which was also above the expectation of 4.09 million. This was also higher than the previous month, which recorded 3.96 million. Now, this also indicates that home sales is still quite strong, and with the home sales taking account of a big portion of the core CPI data, it is also indicating that inflation may stay strong in the near term. As I said earlier, unless there's a meaningful crash in the housing prices, the inflation will stay extremely sticky. Last key data that came out during the week was the core PCE data. Now, the core PCE data is a bit different from the core CPI data, in that while core CPI data focuses on household spending data, PCE data also takes into account of non-households as well. Looking at the data, core PCE for November recorded a 0.1% growth on a month-over-month basis, which was below the expectation of 0.2% and lower than the previous month's 0.3%. This data basically means that based on core CPI data, inflation is still showing a strong trend, while based on core PCE data, inflation is being controlled. The two data can sometimes show conflicting messages given the weightings are different between the two metrics. So with all that, the S&P and NASDAQ were both down throughout the week, with S&P down by about 2.0% and NASDAQ down by about 1.8%. The market went down, reflecting the concerns on the inflation and the interest rate trajectory. Now let's put that all together and see where we are. Let's look at the Federal Reserve table. Taking into account of what happened this week, number one, November retail sales were strong, which indicates that the interest rate cut will be slowed. And number two, 25 basis point interest rate cut happened, but they indicated that the interest rate cut will be slowed. And number three, initial jobless claims were weak, which means that the interest rate cut will be slowed. And number four, Bank of Japan kept the rate constant and also indicated that the interest rate cut will be slowed. And number five, existing home sales was strong, indicating that the interest rate cut will be slowed. And number six, PCE data showed softer numbers, indicating that inflation may be somewhat controlled. So taking all that into account, as I've been saying all along, the Federal Reserve policy is gradually shifting towards Section D. I have also been saying all along that we should really think about slowly shifting from growth stocks to defensive stocks, such as pharmaceuticals and financial institutions. Now, we'll need to continue to monitor how the situation pans out, but as of today, my thesis on the market holds constant that the economy will continue to suffer, with the Federal Reserve, which is becoming more and more hawkish, and the strong consumption power, which is still not cooling down. I'll be back with more market update next week. Let's go over the data and the news for this week. First on the data, core data that came out this week include December PPI, December core CPI, CPI, weekly initial jobless claims, and December retail sales. Now, let's look at the data one by one. The month-over-month PPI for December came out this week, which showed a modest trend compared to the CPI and core CPI and other inflation-related data, which came out over the course of last month. Now, PPI measures the change in the price of goods sold by manufacturers, and therefore it somewhat relates to the ISM manufacturing data, which we reviewed 2 weeks ago. If you look at this table, month-over-month PPI increased by 0.2%, which was lower than the forecast of 0.4%, and previous months of 0.4%. Now, this means that the price of manufactured goods are not increasing as much as the market expected. Now, this is quite understandable considering that the manufacturing data, including the ISM Manufacturing Index, showed a weak trend of below 50 in recent months. While it is a good sign that the inflation is probably somewhat controlled versus expectations, it does puzzle me that the market interprets this as a positive sign with the market going up, given it is a natural outcome from the ISM data. Nonetheless, the market interpreted this data as a positive trend on the inflation. Next major data that came out was the December core CPI and CPI data. Now, this data is what everyone was waiting for, as this is directly related to the inflation trend, which is also strongly correlated to the Federal Reserve's interest rate cut decision. Now, let's look at the core CPI data first. Now, as I mentioned last month, core CPI index is important because it removes volatile items like food and energy, and it provides a more stable measure of inflation trend, which helps the central bank design future policies to achieve a target inflation rate. Now, core CPI for December increased by 0.2% on a month-over-month basis, which was lower than the forecast of 0.3% and also lower than the previous month of 0.3%. Now, the market reacted extremely positively on this news, given it seemingly means that the inflation is now being controlled. However, when you look at the composition of the CPI, I don't know if it's something that the market should be crazy about. Basically, the reason core CPI, which is all items less food and energy, showed a positive trend is really because of the items right here, which are new vehicles, used cars, and trucks and apparel. Now, car sales have been suffering for a long time, and as you can see in the table, price of used cars and trucks fluctuates quite a bit depending on market situations. It goes as high as 2.7% and goes as low as minus 2.3%. I said this multiple times in my previous video, but the most important component in this table is the shelter, which is the most sticky component of the core CPI. If you look at shelter, it is still at 0.3%, which is in line versus the previous month, which still poses a real challenge for the market to control the inflation. Therefore, it is my view that while the market may be going all crazy and happy about the CPI, we still have a long way to go. I mentioned this earlier, but unless there's a meaningful housing price crash, the inflation will stay high for longer. Now, despite the core CPI showing a positive trend, the CPI on a year-on-year basis showed an inline trend versus the forecast, and also higher compared to the previous month. Therefore, this also shows that the inflation is still far from being fully controlled. Now, as I mentioned in my previous videos, the Federal Reserve's target CPI is currently at around 2%, which means that the Fed will do something, either slowing the interest rate cut or decreasing the Federal Reserve balance sheet to lower the inflation to their target level. The inflation rate has been extremely sticky and not going down further from around 2.5 to 3%, which still poses a real challenge for the Federal Reserve. I repeat that I think this will continue to be the case in the midterm unless a big correction in the housing market happens, leading to a decrease in the overall rent and housing prices. The next major data that was announced was the weekly initial jobless claims data. As you can see in the table this week, the weekly initial jobless claims was at 217,000, which was higher than the forecast of 210,000, and was also higher than the previous week of 203,000. Now, this is a positive trend after many weeks of disappointments. Now, as I repeat from last week, a higher initial jobless claims compared to the forecasts means that the job market is bad, which gives the Federal Reserve more means to lower the interest rate. This week, after many weeks of disappointments, this happened, which the market also interpreted as a positive sign. Next major data that was announced was the month-over-month US retail sales. The data measures the change in the sales of retail goods, which acts as a good indicator for consumer spending. In December, the retail sales increased by 0.4% compared to the forecast of 0.6% and lower than the previous month of 0.8%. Now, given the holiday season, the market expected the retail sales to increase by a lot, but it was lower than the expectations, which seemingly implies that the consumer spent less during the holiday season. Now, let's move on to some commentaries on the market based on what happened during the week. Market was generally up during the week, with S&P going up by around 2.9% and Nasdaq rising by 2.5%. As I mentioned before, the main reason for the boost in the market was mainly led by the positive core CPI data, which came out earlier this week. The positive core CPI data basically led the investors to think that the interest rate cut may happen sooner than later, given the inflation may be somewhat controlled. However, I think the market is overreacting for three reasons. Number one, the market has been on a downward trend for almost a month straight, and therefore a week of recovery is a natural trend wherever the market is headed in the future. And number two, as I mentioned previously, the most important component in the core CPI is still the shelter, and housing prices are still showing a strong trend. The core CPI may turn towards a negative trend anytime soon. Number 3, I believe the market was overestimating the December CPI and retail sales trend based on the previous year's trend, which was hugely impacted by the pent-up demand coming out of COVID-19. Therefore, a better trend versus expectations may not mean so much. Now finally, let's take a look at the Federal Reserve policy table to get a sense of where we are. While we're currently in Section C, gradually heading towards Section D, the data which came out this week may put a bit of weight towards the direction shifting again towards Section C. However, as I mentioned previously, we need to monitor the trend for a few more months before reaching a definitive conclusion. We'll see what spans out in the next few weeks. I'll be back with another set of market update next week. Okay, so obviously I've been monitoring the market every day, but I refrained from uploading any market updates in recent weeks, only because there was really not much to say about the market. I mean, it would just be repeating what I said in previous weeks over and over again, reaching the same conclusion. So there's really not much to talk about. But at this point, I thought that it's probably a good time to refresh ourselves with what's been going on. So let me try to explain in simple terms. Okay, so let's try to assess the market by looking at the key data that came out in the previous weeks. As usual, early this month, global manufacturing PMI data, ISM manufacturing data came out. Like previous months, the data showed a strong economic activity with global manufacturing PMI showing a 51.2 versus the previous month of 49.4. And ISM data also showed a 50.9 versus 49.2. ADP non-farm employment change data also came out showing strong as well, with 183,000 versus the previous month of 176,000. Unemployment rate came down even further, showing a 4.0% versus the previous month of 4.1%. Now, most important of all, the data which the whole world was waiting for came out, which was the CPI data. Core CPI on an year-over-year basis showed a 3.3%, which was higher than 3.2% last month, and even higher versus the forecast of 3.1%. Year-over-year CPI came out at 3.0%, which was higher than the 2.9% from last month. Now, this is a status quo from what we observed in the previous months. Basically, the manufacturing activities are still strong, showing a healthy economy. Job market is also strong, with the unemployment rate going down, and CPI is even higher, showing a 3.0% growth. Now, you'll remember that I told you that the market wants a weak economy coupled with lower inflation, so that the Federal Reserve will be steered towards lowering the interest rate and slowing down the Federal Reserve balance sheet contraction. However, the situation is still the opposite. Especially the CPI data, which came out on February 12th, was really problematic for the market, considering this metric is what the Federal Reserve directly monitors to decide their monetary and fiscal policies. Remember that I told you that the Federal Reserve's target inflation rate is 2% level? We're still far away from there, and until we hit that point, it'll be extremely difficult for the Federal Reserve to lower the interest rate. Now, on the other side of the market, Donald Trump has been going full force on implementing the new policies. The new policies were heavily focused on the implementation of the new tariff. First, he decided to impose a 10% tariff on all goods from China and also announced a 25% tariff on all steel and aluminum imports. He also announced potential 25% tariff on goods imported from Canada and Mexico. But these tariffs are delayed by a month. Now, I explained multiple times in my previous videos, but the situation is quite easy to assess. Let's put everything together and try to understand what's been going on. The US manufacturing activities are doing well, unemployment rate is low, and inflation is still high, which means interest rate going lower is still a far-fetched scenario. Now, Donald Trump actually implementing these tariffs is an even bigger threat to the market, given artificial increase of the price of goods by adding tariffs only contributes to the higher inflation. Under this situation, it'll be even more challenging for the Federal Reserve to lower the interest rate. But at the same time, Donald Trump is threatening the Federal Reserve and Jerome Powell to lower the interest rates even further. Doesn't this sound very conflicting? Basically, as an American president, he should, or I guess he should, want the inflation to cool down as soon as possible, but is implementing tariffs which drives the inflation higher, and is also publicly shouting that the interest rate should be lowered, which also drives the inflation higher. Okay, so with all these confusing stuff ongoing, let's try to guess what Trump is thinking and what may happen down the road and what implications it may have to the market. Now, I can think of around three scenarios which are going through Trump's head. The first scenario is the ignore inflation scenario. Now, I don't know what you guys think of Trump, but I don't think he's a dumb guy, so he must be thinking something. So in my view, this scenario is where Trump is basically thinking that he's not held accountable for the high inflation, and everything is just to be blamed on the former president, and he's free to ignore the inflation. Under this scenario, he'll continue to implement the tariffs and force the Federal Reserve to lower the interest rate, and just continue to watch the inflation go higher and higher. Now, under this scenario, the implication to the market will be the following. There's a very good likelihood that the Fed and Jerome Powell will continue to resist Trump's orders, and down the road, either Jerome Powell starts to slowly lower the interest rate or he gets replaced with another person who will lower the interest rates. Now, as I told you, lower rate implies more liquidity in the market. So technically, it should increase people's purchasing power. But they'll be faced with a high inflation, which at the same time reduces people's purchasing power. Now, at this point, if Trump decides to lower the taxes as well as he always said he will, people's purchasing power will be boosted again, outplaying the high inflation. So basically, despite the tariffs and high inflation, strictly within the US, the economy will continue to somehow function in a normal way, with the high inflation just kind of laying by our side at all times. While the US may sometimes get by, this will be a disaster scenario for the rest of the world. Now, the reason the US can afford cutting taxes and implementing high tariffs is because they have the most lethal weapon in the world, which is the dollar. Because the dollar is the fiscal currency of the world, they can continue to print the dollar to fund the losses from their taxes and pay the high cost of inflation. But for the other countries, if they accelerate the supply of their currency to play along with the US, their inflation will be even higher because their currencies are very weak versus the dollar and ultimately fall into a hyperinflation trap, which will make their currencies worthless. So in this scenario, the impact may be neutral for the US economy and the market, while devastating for the rest of the world. Obviously, the US will be impacted to some extent with other countries falling apart, so I won't say it will be good for the US either. Now, the second scenario is the fake blaming the Fed scenario. Now, I don't know, but deep in Trump's mind, he may be very wary of inflation. But even under this scenario, he needs to show everyone that he cares about their investments and 401k. So he's basically pretending that he wants a low interest rate, but the Fed is not listening to him. He might even be having side conversations with the Fed, saying that he's just acting for his popularity's sake. So just act in accordance with the inflation data. Now, under this scenario, Trump may continue to implement the tariffs, given that this is what he promised to the world, and keep crying out that a low interest rate is needed, but he'll trust that the Fed will keep the interest rates high. This way, Trump can achieve three things. Number one, he can fulfill his obligations by doing what he told the people he'll do, i.e., implement the tariff. And number two, his actions will be protected from the high inflation, with the Fed keeping the interest rate higher for longer. And number three, he can maintain his popularity by blaming everything on the Fed and acting like he cares for people's investments. An ideal scenario for Trump, right? Now, under this scenario, the US economy and the market will obviously suffer due to high inflation and high interest rate. For the rest of the world, it'll be the same, so everyone will suffer. Now, the third scenario is the fake the tariff scenario. Now, until today, Donald Trump is acting like he's about to implement the tariff to the world. But if you think about it, he did implement a 10% tariff on China, but he did give some leeway, saying anything under $800 will be exempted from the tariff. He also did implement a tariff on Canada, but he delayed it for 30 days. He also did implement a tariff on Mexico, but he also delayed it for 30 days. Now, up until today, while there has been so many news reports, nothing really happened apart from a small 10% tariff on Chinese goods. Now, this makes us wonder whether Trump really wants all these tariffs to be implemented from the first place. So, assuming he's faking all these tariff announcements, what will be the implications on the market? For the US economy and the market, it'll be neutral, i.e. the same as now. Inflation will still be high, but not that high, at around 3% level. and interest rate will continue to stay high for a bit longer, so not good for the market, but not much worse off than now either. Same for the rest of the world. So these are the three scenarios I'm envisioning at the moment. What are your thoughts? Let me know in the comments down below. But what I want to say is that number one, at the best, the market will be neutral. And number two, inflation will stay higher for the foreseeable future. And number three, interest rate may stay higher for a bit longer. So my recommendation still holds the same. I know there has been some wild news like the DeepSeek and all that, but even that aside, I recommend slowly transitioning from growth stocks to defensive stocks like pharmaceuticals and low price to earnings ratio companies, just like I have been saying for the past few months. I'll be back with more videos very soon. Before I begin, I want to emphasize that I'm doing this kind of market update because understanding the Federal Reserve policies and the macro is the most important aspect to consider when investing. Without these updates and knowledge, whatever you invest in, it is highly likely that you will not succeed. And even if you succeed, you'll not learn much because you'll have no idea why you succeeded. So, although this may be boring stuff, please watch the clip till the end and try to listen carefully and understand the logics and technicalities behind it. Okay, on January 18th, 2025, I uploaded a video saying that I was observing the dumbest market I've ever seen, given the market was rising at the start of the year, despite the negative data that was coming out. I gave 3 reasons why the market was dumb for going up at the start of the year. Number 1, market was down for some time towards the end of 2024, and therefore the recovery in 2025 was natural to happen, given the market generally bounces back after some time of a downfall, and so it's nothing to be happy about. And number 2, the most important component of the CPI is the shelter, and I didn't see any signs of shelter price going down, which means that a more downward trend is highly likely. And number 3, retail sales underperforming the expectations will not contribute to the interest rate going down, given the expectations were stretched based off the strong trend coming out of COVID. The message I was trying to make clear was that, number 1, the market was so dumb to expect a rally just because Trump is re-elected and he'll go full force in pulling the market up. And number 2, the market was even more dumb to expect the interest rate will go down in the near term just because Trump was shouting for a more liquid market. And number 3, the market was the dumbest for still chasing after classic growth stocks even when the data was strongly indicating the opposite. I said this multiple times, so I won't go into further details. Now, following the video in January, I uploaded a video on February 18th laying out 3 different scenarios which may happen in the market. Today, I want to go over the 3 scenarios again and see where we are headed. The first scenario was ignore inflation scenario, where Trump just blamed the inflation on the former president and just does what he does all the time by lowering the interest rate as soon as possible and providing more liquidity in the market to jack up the stock market. Now, as I say all the time, I don't think Trump is a dumb guy, and I'm very certain that he realizes the consequences of a high inflation. Now, as I said in my previous videos, that under this scenario, the impact will most likely be neutral to the US, while being a disaster for the rest of the world. However, the reason I said it'll be neutral to the US and not good for the US is because under this scenario, what do you think will happen to the US? I mean, one obvious thing that'll happen is that the US dollar will be stronger than ever. Now, do you think this is good for the US? No, this is bad for the US, given strong dollar means that other countries in the world will feel a much bigger burden to purchase US products. Whatever the product is, whether it's Apple, Nvidia, Tesla, or whatever, it'll most likely be more expensive to purchase those US products in their currency, so US exports will face a catastrophe. Now, the domestic consumption will still most likely be good for the US, given its economy will be sustained. But what I'm trying to say is that because these are negative consequences for the US, it'll be challenging for Trump to go full force with lowering the interest rate, as he would well understand the consequences. Now, going back to the scenario 1, we can certainly see that Trump is not ignoring the inflation. He's pretty much doing what he can to fight the inflation. For example, his implementation of Doge with Elon Musk to cut costs and control the hot job market, and also his efforts to increase the oil supply to decrease the commodity cost. However, this is obviously not enough. This is why 3 days ago, Jerome Powell proudly came up saying that the Fed will wait as long as it takes to see how Trump's aggressive policy actions play out before making any decisions on the interest rate. The job market also added 151,000 non-farm payrolls in February, which was slightly below expectations. But Powell also commented that the labor market is solid and broadly in balance. He also said that wages are growing fast than inflation and at a sustainable pace than earlier in the pandemic recovery. Okay, so the conclusion I'll make today is that scenario 1 is now dead. There's really no chance of Trump ignoring the inflation based on what he has been saying and doing so far. And I would say that he's very wary of the situation. After all, this was the lowest likelihood scenario anyways. Only way to get out of this mess is for the March CPI data, which is coming out very soon, to be much better than expectations, but we'll need to see how it spans out. Now, the second scenario was fake blaming the Fed scenario. Basically, this scenario was Trump shouting out for a low interest rate, but behind the scene, telling the Fed to do what they need to do to cool down the inflation. I said that Trump can achieve 3 things by doing this, which is, number 1, he'll be keeping his promises of implementing the tariff, and number 2, he'll look like he cares about people's investments and 401k, and number 3, by doing so, he can maintain his popularity. I also said that the scenario will be bad not only for the US markets, but for the rest of the world as well, given it means that the market will not have much liquidity for the mid to long term, while tariffs will be implemented. The less liquidity and more tariff combined together is really bad for the market, given it means that interest rate will remain high to bring the inflation down. But tariffs will pressure the inflation to go higher, which will be then pressuring the interest rate to go even higher. So we fall into this kind of a vicious cycle where we fall into a never-ending inflation trap, which we cannot escape. Now, on this scenario, I don't know if Trump is having a side conversation with the Fed, but they're surely sending conflicting messages. And to be honest, I feel like Trump's pressure towards the Fed has also kind of cooled down a little bit. He's also trying to find solutions himself to cool down inflation. And so, while I don't know whether Trump is having the side conversation with the Fed, I would say that the current market looks quite similar to scenario 2. And this is why the market dropped so much, especially the growth stocks, which can only survive under a high liquidity environment. So I'll say that scenario 2 is still valid and ongoing. Thus, we need to be careful when approaching the market. Now, moving on to scenario 3, this was the fake the tariff scenario, where Trump acts like he'll implement a huge tariff, but doesn't actually do so to keep the stock market positive. Now, situational update is, in February, Trump announced a 10% tariff on China and 25% tariff on goods from Mexico and Canada. From Mexico and Canada, he announced a 1-month delay, but the 1 month has lapsed, and the tariffs actually went into effect shortly after. However, after that, Canada also announced a retaliatory tariff, saying that they'll cut off all the electricity exports, which led Trump to announce that a subset of goods covered in the US, Canada, Mexico agreements will be exempted from the tariffs. Now, those goods cover around 38% of imports from Canada and around 50% of goods from Mexico. So as you can see, Trump is somewhat kind of implementing the tariffs here and there, but it's nowhere near the level he preluded prior to his presidency, and he's also continuing to give leeways to the countries depending on the circumstances. Trump also did set up a thing called a ERS, which stands for External Revenue Services, which assesses potential tariff implementation on all the counterparty countries. So Trump is somewhat showing his willingness to do all the tariff-related things, but when things actually happen, it makes the market wonder whether he is actually going full force with it. Now, the reason we feel that way is because of the same reasons we laid out above. Trump is extremely worried about the strong dollar and inflation, that he can't go full force with anything. He can only do that when the inflation is low and dollar is controlled so that there's no impact on the US economy. But right now, things are the opposite, and Trump has too much stuff to care about. So I think the scenario 3 is somewhat still valid, but in a different way. I think deep in Trump's mind, he wants to go full force with the tariffs, but he can't do that because of circumstantial issues. And therefore, while Trump is not faking it, the outcome is somewhat similar due to what's been going on. So the conclusion on the latest market is simple. Number 1, unless the March CPI data really turns around, the market will likely continue to suffer, with the growth stocks suffering the most due to inflation. And number two, the strong dollar and high inflation will continue to limit Trump's ability to implement the tariff. And number three, with all the uncertainties ahead, flight to safety mentality may drain the money in the stock market more and more. Now, I would say that 1 and 3 are negative to the stock market, while 2 is neutral to the stock market. So my conclusion still holds the same. The Federal Reserve chessboard is still shifting towards low liquidity case, and under this environment, we need to be extra careful and sit on the sideline and monitor the market, especially the CPI, to get a sense of what will happen next. I'll be back with more market updates very soon. Okay, so I was not going to do another round of market update considering I gave an update last week. I was actually going to wait until the next CPI data comes out. But I was monitoring the market and the Fed's rate decision yesterday, and I just had to shoot this video clip as I thought there are some meaningful things to say about what's going on. Before I begin, I just want to repeat what I said once more. Familiarizing yourself with the macro and political situation is the most important factor to succeed in investing, especially nowadays. So please watch my macro clips till the end to understand what's happening in the market. I really need your full attention here. Okay, so let's go over the obvious facts first. On March 19th, 2025, the Federal Reserve decided the new interest rate, which was held constant at 4.5%. Now, this is what we all expected as well, so this was not a surprise at all. Also, the Federal Reserve officials released their new dot plot for the future interest rates. Basically, a dot plot is an economic forecast released by the Federal Reserve policymakers to show their expectations on where the interest rate will be at the end of 2025, 2026, and so forth. So this is the new dot plot released by the Federal Reserve. Basically, the Federal Reserve policymakers' expectation is that based on the current economic data that they're seeing, by the end of 2025, the interest rate will be at somewhere around 3.9%. Which means that they expect around 2 rate cuts within the year. Now, for those of you who are not familiar with the trend, you can just think that the consensus remained pretty much the same as back in December. So nothing changed meaningfully. However, this was not a bad thing for the market given everything was within the band of expectations, and therefore the market showed a relatively positive trend by going up by around 1%. There's another factor which came into play, which is the slowdown of the Federal Reserve balance sheet contraction, but I'll get to that later in the video. Now, all the facts aside, what mattered is what Jerome Powell said at the press conference yesterday. Now, just to give you guys some idea, Jerome Powell's press conference is probably the most powerful thing that happens in the market these days. Depending on what Powell says, the entire market can suddenly go up by 3 to 4% in an instance, or can go down by 3 to 4% in a second. So this is basically what everyone was waiting for. Let me just extract some quotes from Powell from yesterday's press conference and share it with you. Number one, recession projections have moved up, but still not high. Number two, US economy is strong overall, but there are signs of weaknesses among consumers. And number three, if the economy remains strong and inflation does not continue to move towards 2%, we can maintain policy restraints for longer. Okay, so up until this quote, things look pretty much normal. Basically, what Powell is saying is that the economy is still strong and inflation is high, so we can keep the interest rate higher for longer if needed. Also, there are signs of recession, but he doesn't see it coming anytime soon. Up to this point, everything is within what we expected, and there's no surprise at all. But Powell carried on saying the following quotes. Number 4, tariffs may delay inflation progress. Number 5, the new administration is in the process of implementing significant policy changes. These policies will matter for the economy and for the path of monetary policy. Number 6, a good part of higher inflation is coming from tariffs. Okay, for the last 3 quotes, what do you think is happening? Okay, so basically what Powell is saying is that he doesn't know what to do with the monetary and fiscal policies because of the tariffs. In other words, what he's saying is, hey, Donald Trump, I got no clue what to do because of you, brother. You better give me some certainty. Okay, now, I can see why he's saying this, but is it just me who's feeling like Powell is kind of blaming his situation on Trump and the new administration? Okay, now, a natural question now becomes, what is Trump thinking? Okay, let's go over some quotes from Trump in recent days. Number one, the economy went to hell under Biden. Number two, inflation is back, but I had nothing to do with it. Number three, the Fed would be better off cutting rates as US tariffs start to transition their way into the economy. Okay, so what do you think Trump is saying? He's basically still blaming Biden and the former president for the inflation and telling the Fed to lower the interest rate. I mean, Trump is obviously not ignoring the inflation per se, given his efforts with the oil supply and cost-cutting efforts, but he's still publicly saying that he can't do what he wants to do because of the Fed. Okay, so to summarize the situation, this is what's happening. Basically, Powell is doing his job, but he's getting so fed up with all the policy changes, which makes the market uncertain. So it's just coming out straight saying, hey, Trump, you're really driving me crazy. Now, what Trump is saying is, hey, I don't care about inflation because that's Biden's fault, and I don't want people's consumption power being diminished because of my tariffs. So Powell, just bring the interest rate down as soon as possible. But then what Powell is saying is, hey Trump, unless you make things clear on the tariff side, I won't make any moves. So as you can see, basically it's a circular situation where Powell is telling Trump to do something on the tariffs before lowering the rate, and Trump is telling Powell to just lower the interest rate before doing the tariff. And I guess Biden is just being thrown around here and there at the moment. So this is a very weird and unprecedented situation where the Fed and the president is staring at each other, telling each other to take actions, while neither one is really doing anything. I mean, guys, come on, I'll be upfront here. Is this how a country's monetary policies and administrative policies should be run? I mean, I feel like they're both thinking too much about their own interest and not taking into account of the people and the investors. I'll say once more that I don't think both Powell and Trump are dumb guys, but I think they're too wary of the public sentiment that they're not giving any clear guidance on where the country and the world is headed towards. Okay, separately, Powell did make one bold and clear statement though. He said that he'll slow the balance sheet contraction pace. Remember that I told you in my previous videos that the Federal Reserve's balance sheet is one of the key metrics to monitor to gauge the market direction? I also told you that the Federal Reserve balance sheet was going through a contraction phase, which is not good for the market liquidity. Yesterday, Powell mentioned that he'll slow the tapering of the balance sheet from the original $25 billion in a month to $5 billion per month. So basically, Powell is giving a little bit of room to the market to slow down the liquidity draining out of the market. On this point, given the recent market drop and signs of recession, I think Powell is giving some leeway for the market so that a recession actually doesn't get triggered. So this is not bad for the market. Okay, so overall, my conclusion on the market from yesterday's FOMC is per the below. Number one, Trump and Powell really need to come to a conclusion on how they're going to deal with the situation. The more they blame each other on everything, a recession might really come, which will make people suffer. Number two, we may need to wait a bit longer for an interest rate cut, given Powell's speech yesterday. If the next CPI data comes out with a surprise, this may be expedited. Number three, the slowdown of the Federal Reserve balance sheet tapering is a good thing for the market. I think Fed is really taking into account of a potential recession, which it really wants to avoid. Okay, so I think uncertainties are just rising in the market, though I won't say anything is better or worse than it was last week. But I just want to emphasize that Powell and Trump really need to man up and stop blaming each other and figure things out on each of their side to bring inflation down as soon as possible. Otherwise, we might really see a recession coming. Thanks for watching, and I'll be back with more videos very soon. Okay, so as I say all the time, understanding the macro, the Federal Reserve policies, and the government policies are the most important aspect to consider when investing, especially after the global financial crisis era. Looking at the market in recent weeks, I think it was a very good representation of why such statement is true. Okay, so I think it's a good timing for us to do a recap on where we are with the market. So let's get to it. Now I want to deep dive into the key data that came out in the past 2 weeks. These are some of the key data that came out. S&P Global Manufacturing PMI for March was at 49.8 versus expectation of 51.9 and 52.7 of the previous month. Now, As you may all remember, I've always been saying a number below 50 is considered a sign of weakening of manufacturing activities. So basically, the data showed that the economic activities are weakening versus what we expected in the previous month. Consumer confidence was at 92.9, which was lower versus the expected 94.2, and also lower versus the previous month of 100.1. So in accordance with the PMI data, consumers' consumption activities also showed a weakening trend. Also, ISM manufacturing PMI also fell to 49.0, which was lower than the expectation of 49.5, and also lower than the previous month of 50.3. The Federal Reserve balance sheet was at 6.74 trillion, which was slightly lower than the 6.76 trillion of the last month. Okay, so if we look at all those data, basically the message which the data is telling us is that the manufacturing activities are weakening and consumers are also feeling the economy is weakening, so losing confidence in spending. At the same time, the Fed balance sheet is still contracting, though at a slower pace, which is slowly draining the liquidity out of the market. Now, the Federal Reserve balance sheet aside, how do you think we can interpret the data? Well, some of us might be thinking that, okay, there's a pretty famous notion which says bad is good, and given the data is bad, maybe it'll be good for the market. Well, let's try to see if that's the case. Now, after the Federal Reserve started adopting the quantitative easing and started manipulating the interest rate frequently, the bad is good notion became quite popular, meaning that if the data is bad, the market goes up. Now, this notion works because the Federal Reserve's role is to prevent unemployment from going up. Generally, if the economy is bad, the Federal Reserve gets extremely worried about the unemployment rate going up. So they would either decrease the interest rate or increase its balance sheet to provide more liquidity into the market. Okay, so to assess the situation, basically the chains of reactions goes like this. Economy shows signs of weakening, for example, bad ISM, PMI, consumer confidence data, which leads to the Federal Reserve being worried about the unemployment going up, which leads to the Federal Reserve either lowering the interest rate or increasing its balance sheet, which leads to the market going up. I explained why the market goes up when the interest rate gets lower and when the Federal Reserve balance sheet increases in my investment strategy video. So if you haven't checked it out, please check it out. Okay, so this is simple. Now, if unemployment rate is actually increasing, the Fed may be able to take such actions. However, the US unemployment rate, which came out this week, showed a 4.1%, which didn't change from the previous month, and still at a very low level. So the Federal Reserve does not have any ground to decrease the interest rate or increase the Federal Reserve balance sheet. Also, there's one other thing which the Federal Reserve extremely cares about, and that is the inflation data. Now, the data which came out related to inflation still remained a problem. Core PCE price was at 2.6% versus 2.7% expectation, but a lot higher than 2.2% of last month. Also, more importantly, Michigan one-year inflation expectation was at 5.0% versus 4.9% expectation, and a lot higher than 4.3% of last month. Basically, Michigan inflation expectation is a representative data showing how the consumers are viewing the inflation to span out in the next 12 months. Now, as I said all the time, the Federal Reserve's inflation target is at 2%. Decreasing the inflation from 2.8%, which was the figure from February, to 2.0% is extremely, and I repeat, it is extremely hard. Now, having that said, if the consumer expectation on inflation is at 4.3%, this is a disaster for the Federal Reserve. Now, this is partly the reason why the market went down so much in the previous weeks. Now, with that, if we try to reassess the above chain reaction, taking into account of the unemployment rate and inflation data, it comes down to this. Economy shows signs of weakening, for example, bad ISM, PMI, and consumer confidence data. The Federal Reserve will look at the unemployment data. The Federal Reserve sees low unemployment data, and the Fed is stuck. Also, economy shows signs of weakening, for example, bad ISM, PMI, consumer confidence. The Federal Reserve will look at the inflation data. The Federal Reserve sees high inflation data, and the Fed is stuck. So either way, the Federal Reserve is stuck and cannot do anything. Also, with the potential tariff being implemented to the whole world, which we'll get to later, they have to be even more wary of the inflation data. So they have absolutely no grounds to decrease the interest rate. Now, the data which came out in the past week was a loud and clear announcement to the whole world that the Federal Reserve is stuck, which was disastrous to the market. Okay, so basically what's happening is this. Basically, the economy is weakening, but the inflation is still high. Now, based on the data, we're basically entering a new realm of stagflationary economy. Just about a couple of months ago, or even just a month ago, the manufacturing data and ISM data were still strong, meaning that the economy was still strong, while we had inflation. Now, the scenario can be called an inflationary environment, given the strong economy and inflation coupled together, which is not ideal, but something we can live with if we don't pay too much attention to the stock market. I mean, generally, as long as the Federal Reserve keeps the interest rate high and continues to decrease the balance sheet, inflation will cool down at some point, and as long as the economy is strong, a country will be okay. Now, the problem with a stagflationary economy is that if the Federal Reserve keeps the interest rate high and continues to decrease the balance sheet, it'll hurt the weakening economy even more. Now, the inflation is also underway, so basically what this means is people may be losing jobs and suffering because the economy is doing bad, and people will suffer even more because the Federal Reserve has to keep the interest rate high and drain the liquidity from the market. And people will suffer yet even more because the prices are rising, which decreases their purchasing power. So basically, it's a triple whammy situation for everyone, which is almost impossible to fix. Now, with this situation, the US is facing a lot of problems. Remember I told you that the components of a country's GDP is C, G, I, and X? C is consumer spending, G is government spending, I is corporate investments, and X is net exports. Now, with the stagflation situation, obviously the C, which is consumer spending, will be gradually weakened. I, the corporate spending, will also be impacted as corporates will make less money if consumers don't spend. And X, which is net exports, will also go down because the dollar is currently strong. Now, a lot of you ask me why the dollar is strong, and a dollar is generally considered strong if the dollar index is above 100. Also, with the stagflation, the US have no ground to decrease the interest rate, which means the US will most likely have a high interest rate in the near term as well, which may further strengthen the dollar. Basically, what this means is that out of the 4 components, 3 key components may face challenges, which may bring the US GDP down even further. Okay, now this is where Donald Trump steps in. Now, similar to the Federal Reserve, Donald Trump and his administration is kind of hitting a roadblock where they only have limited options to consider. By the way, this is just my personal thought, but I can kind of see why Trump is blaming Biden so much. The current situation is really incurred from the former administration's excessive spendings to keep the economy afloat during COVID, which I'm not sure was entirely necessary. I mean, it was necessary, but looking at how much people's savings in the bank account increased during the past few years, there were quite a bit of surplus which was provided to the people, which I believe was an action to get re-elected in the next presidential election. Okay, now, that aside, as a measure to all of this happening, Donald Trump is going full force with the tariffs. On April 2nd, so to speak, the Liberation Day, Trump announced 10% tariffs on all imports into the United States, and even higher tariffs on goods from around 60 countries, including China and European Union, which will be imposed with 34% and 20% tariffs. The baseline 10% tariff will go into effect on Saturday, and any higher tariff will go into effect on April 9th. Also, the 25% tariff on goods from Mexico and Canada, which were formerly imposed will remain in place until certain issues around fentanyl and illegal immigration have been resolved. Okay, now these are all over the news, and the factual stuff can be read by anyone by themselves, so I won't go into further details. But let us focus on what is really important, the implications and predictions. Okay, in order to do that, let's go over some quotes by Donald Trump. Number 1, the tariffs are going to give us growth. Number two, jobs and factories will come roaring back into our country, and you see it happening already. Number three, this is not full reciprocal, this is kind reciprocal. Number four, for years, hardworking American citizens were forced to sit on the sidelines as other nations got rich and powerful. But now it's our turn to prosper. Number five, I say terminate your own tariff, drop your barriers, don't manipulate your currencies. Okay, in addition to what Trump said, JP Morgan's chief economist stated that the Liberation Day announcement could boost PCE prices by 1 to 1.5 percentage point this year, which would most likely be realized in the middle of the year. So basically, from the current inflation of somewhere between 2.5 and 3%, inflation can even increase to around 3.5 to 4.5% level, which will be even more catastrophic to not only the US, but also to the world. However, in this situation, it all comes down to which outweighs the other. For example, if the economic outlook is a lot worse and serious than the inflation, the Federal Reserve will have to cut the rates. If it is the other way around, the Fed will not be able to cut the rate. Strangely, the economist seems to be predicting that the economic downturn will be more severe, and therefore the Federal Reserve will have to cut the rate starting from June. I'm not entirely sure whether that is true, but we'll have to see how it spans out. Okay, so with all that, why do you think Trump is taking such radical actions, and what could be some of the predictions that stems out of it? Remember I told you that the economy is composed of C, G, I, and X, and due to the stagflationary environment, 3 components out of the 4 are getting destroyed. Basically, my interpretation is that Trump is trying to save the country's GDP by implementing these tariffs. If you think carefully about the tariffs, basically the tariffs are implemented towards the goods which are being imported. Now, what this means is that if a foreign corporate comes into the US and builds factories in the US and starts producing in the US, those goods will not be impacted by the tariffs. Okay, so basically what this means is that the I component, which is corporate investment, will be somewhat saved with this measure. Also, if foreign corporates come into the US and starts manufacturing, they have to hire US workers. Now, if more US workers are getting hired and get paid from the foreign companies, they will get more income, and the C component, which is consumer spending, will also be saved to some extent. Now, my another prediction is that leveraging the tariffs, Trump will threaten other countries to strengthen their currencies. Now, some of you may know about the Plaza Accord, which happened in 1985. Basically, back then, the US exports were getting destroyed because of other countries' currencies, including French franc, German mark, Japanese yen, and British pound, being so weak against the US dollar. Now, through this meeting, the other countries agreed to strengthen their currencies against the US dollar. And what were the consequences? Japan, which was the biggest threat to the US, ended up experiencing the most ridiculous bubble of all time and crashed altogether, going into 20 years of low growth phase. Now, I believe this is what Trump wants. He wants to get all the countries to come in front of him and agree to a certain currency adjustment, which will benefit the US and harm the economy of the other countries. After all, I'm more than certain that Donald Trump is concerned about the US and the US dollar losing its position in the international market due to the disruption of other countries led by China, and he wants to fix everything in one go. Now, the side effects of doing so will be obvious. Donald Trump will have to embrace his popularity going down, not only in the international markets, but also in the domestic markets as well, because the stock market and other capital markets will face huge uncertainties due to all these radical interventions. But my view is that Donald Trump has more important things to flush out at the current moment than worrying about his short-term popularity or short-term movement of the stock market. Okay guys, so this wraps up what has been happening in the market in recent weeks. A lot of uncertainties are ahead of us, and as I said all the time, we're still in an illiquid market environment. Also, even if the Federal Reserve decides to decrease the interest rate from June, that doesn't mean the market is going to be liquid. It would just be a temporary measure to defend the economy against it going down even further from here. So it's not a healthy decrease of the interest rate, so we need to take that into account. Let's all be careful with our actions and try our best to avoid losing money for the time being. Thank you, and I'll be back with more videos very soon. I started this YouTube channel on November 15th and started talking about what causes a market crisis and general market updates from late November and mid-December. Part of the reason I started this YouTube channel was because I somewhat sensed another interesting market environment coming, whether it's caused by geopolitical issues, excessive CPI, which gives limited options for the Federal Reserve, or just plain political issues which may be incurred given Donald Trump is starting his second term as the President of the United States. Now, I just want to give you a quick history of how my thoughts on the market evolved by giving you a recap on the videos I uploaded. I sensed that the market will be experiencing a meaningful downturn, as I mentioned in my Recession Might Really Be Coming video, which I uploaded on December 12th. And on January 15th, I uploaded a video saying, "This is the dumbest market I've ever seen, given the market was rising at the start of the year, not knowing what may come." Then, on February 15th, I uploaded a video saying, "Watch out, this will happen in the market," giving 3 scenarios which may happen in the market, which mainly involves how Trump and the Federal Reserve will set the tone of the market. Afterwards, I uploaded a series of market update videos in the past month saying that we should all be careful with our actions, given the market may act against our will. By the way, I'll upload a long compilation version of my market update videos for some of you who might want to watch the videos in one go. If you watch the videos, you'll get a good sense of how I predicted the market to go down since late last year, and this will be a very good tool for you to learn how to read the macro data and how to analyze them. Okay, so looking at the market, I had to upload another video today because there's just been too much happening in the market, and I wanted to just kind of reassess the views we had on the market and see where we are headed. Okay, over the course of last week, not much meaningful data came out, and even if they came out, no one really cared about them because everyone was so focused on a single word: tariff. And as I mentioned in my previous market update video on Liberation Day, Trump announced a 10% tariff on all imports into the United States and higher tariffs on goods from around 60 countries, including China and European Union. The baseline tariff was 10% for all the countries, and for Mexico and Canada, the 25% tariff also was imposed, which went into effect. Okay, so a lot has changed over the last week, so let's just recap the tariff rates for the key countries. 31% on Switzerland, 36% on Thailand, 25% on South Korea, 26% on India, 24% on Japan, 46% on Vietnam, 20% on European Union, and 104% on China. Okay, for those of you who don't know how the 104% came about, it's basically the initial 10% tariff imposed on China over fentanyl concerns in February, followed by another 10% extra imposed in March, plus another 34% imposed around Liberation Day, and another 50% imposed as a retaliatory measure against China's retaliation against US goods. Okay, so factual stuff are all over the news, so I won't go into further details. Again, let's focus on what's important: implications and predictions. Last week, I noted that based on research data, the Liberation Day tariff announcement could boost PCE prices by 1 to 1.5 percentage point this year, which would most likely be realized in the middle of the year. So basically, from the current inflation of 2.5 to 3%, inflation can even increase more to around 3.5 to 4.5% level, which will even be more catastrophic to not only the US, but also to the world. But over the course of last week, with the newly announced tariff measures, I'm not even sure whether the impact on inflation can be calculated anymore. These nonsense numbers are just making predictions meaningless, and because it is meaningless, I feel like economists have now given up on making any hard predictions on what will happen. But what happened already happened, so let's try to go over the current environment. Number one, inflation is now super vulnerable. Even if the short-term inflation goes down, if the current tariff
plans are implemented, CPI in the second half will rebound very quickly. Number two, Federal Reserve is getting busy. Current prediction is skewing towards a rate cut starting from June or even from May. Some analysts are now expecting around 4 rate cuts within the year. Number three, market is down quite a lot within the range of 20 to 25%. Forward price to earnings ratio of big tech stocks with decent earnings are now in the range of 20 to 25 times versus 30 to 35 times a few months ago. Okay, having that said, let's try to see what may happen moving forward. First, let's try to get a sense of the best case scenario and the worst case scenario. This would be the best case scenario that may happen in the market. Number one, starting with Japan and South Korea, multiple countries follow the two countries in settling tariff terms with the US. Somehow, all countries reach an agreement on a tariff rate which effectively adjusts their export pricing to the extent it just reaches a similar level as adjusting their FX rate to a few years ago. Number two, China gets isolated and the US has strengthened its relationships with all other nations, and China has no choice but to strike a deal with the US. Number three, while this tariff settlement is ongoing, in order to keep the economy afloat during the chaotic times, the Federal Reserve starts cutting the interest rate from May and achieves around 4 rate cuts within the year. Number four, during the chaotic times, US consumers significantly reduces their spending to prepare for a recession, and CPI data gradually comes down to 2% level, justifying the Federal Reserve's rate cut. Okay, under this scenario, there are multiple sources which can push the market up and up and up. Remember that I told you that investors are always focused on forward-looking and moves a few steps ahead? Under this base case scenario, every time each country reaches a settlement of the tariff, market will go up, and every time the Fed cuts the rate, the market will go up. And as the CPI data comes down, the market will move up. As a result, this base case scenario can trigger a new bull market. Okay, next, let's look at the worst case scenario. Number one, China and the US continues to fight over tariff, continuing to take retaliatory actions, and other countries also follow China's lead, fighting against the US, which delays any settlement of the tariff. Number two, the US is short of allies to purchase newly issued US Treasury bonds, and US's funding capability gets significantly reduced. Countries like Japan and South Korea may still purchase US bonds to maintain their relationships, but it'll not be enough. Number three, the Federal Reserve will decrease the interest rate significantly to save the economy, but it'll only heighten the inflation level across the nation, which accelerates the stagflationary situation. Number four, China really goes to the extreme path and starts selling US treasuries in the market. This will effectively cause a collapse of the dollar and the US monetary system, which may really evolve into something which may make the US even consider taking some sort of physical actions involving its military. Okay, what do you think? Please keep in mind that the two scenarios I laid out are really, and I mean really, extreme scenarios. Do you now get a sense of how uncertain the current situation is? Both are very extreme cases, but not impossible scenarios based on what's been going on in recent weeks. Okay, but we do need to take actions accordingly, so let's see what would be some smart ways to take actions in accordance with the current environment. Now, if we were to come up with a mix of two scenarios, which may be more reasonable, one scenario which may happen is this. Number one, some countries which must do trades with the US to protect their GDP. It might not be China and some other nations which continues to retaliate against the US, but some countries like South Korea and Japan may negotiate terms with the US. Number two, the US will somehow squeeze its newly issued bonds down the throat of its ally nations, which play along with the US by potentially offering better trade terms down the road. Number three, like in both scenarios, the Federal Reserve will prioritize saving the country's GDP by lowering the interest rate starting from the middle of the year. Number four, CPI will be extremely difficult to bring down, especially with the interest rate going down, But as the overall GDP growth of the US is slowing down with the tariff situation, consumer confidence also continues to decline, keeping the CPI stable at current level. Okay, so this is a random scenario which kind of mixes the best and the worst scenario here and there. But however I try to mix the two, I seem to reach a same conclusion. Basically, geopolitical impact on the market in the midterm down the road is most likely neutral to negative, especially assuming that the Fed is going to lower the interest rate quite actively. Now, geopolitical and political things aside, valuation has come down a lot. As I mentioned previously, valuation of large global tech companies have come down by around 25 to 30%, or for some, even more than that. Non-tech companies' valuation have also come down quite a bit, which makes their valuation quite attractive. Now, for those of you who have been listening to me and watching my videos over the past few months, I'm sure you have been sitting on the sideline with cash, monitoring the market, wondering what you should do. Now, my view is that considering the attractive valuation, we should carefully monitor the market and always be prepared to enter the market whenever the geopolitical issues shows any signs of positive development. If circumstances allow, I think even slowly, and I mean very slowly, buying into the market in piecemeal from now would also be a good strategy to think about at this point. Obviously, you will have to pick the right stocks. In order to get a sense of the stocks to pick, please refer to my stock investment strategy for everyone video and try to focus on type B and type C stocks. Basically, the stocks which have decent growth and decent profitability with fair to slightly higher valuation would be good stocks to buy, especially if we assume that the rate cuts will take place in the next few months. Now, on the geopolitical and political issues, I don't want to make wild assumptions, but I will say this. Generally, these types of non-fundamental noises which impact the market goes away as time goes by. After the US announced a 104% tariff on China, even myself started thinking that these numbers don't mean anything anymore. What difference does it make? 100%, 1,000%, 10,000%. These are all the same, just some random arbitrary numbers which sound too remote to stay in the market permanently. So while we do need to care about the geopolitical and political noises that are happening in the market, it is time for us to focus on the fundamental valuation of companies too. Okay guys, now I know I've been very negative on the market since I started this YouTube channel, and I've been telling you guys all throughout that we need to be careful and extra careful and even more careful so that we do not lose money. I'm sure my warnings already paid off a lot for all of you guys watching. The reason I gave you those warnings was because I actually thought a crash like we experienced in the past few months may happen. And it actually happened. The market now corrected over 25%, and I think it's about time we shift the gears a little bit and actually think about when would be an ideal time to buy into the market. As I said, very slow, and please focus on my wording, very slowly buying into the market at this point may also not be a bad idea. After all, which stock to buy and when to buy is your choice. But I just want to make one thing clear. Let's now monitor the market closely with a less negative bias and be prepared to take actions accordingly. Now guys, with this, I plan to refrain from uploading market update videos as frequently as I did in the past month. I had too many messages I want to convey to you guys, and I believe that my job is done for now. I did my best to keep you guys from losing money during the past few months, and from now on, as I said, please try to make your best judgment to play around with the market. Please refer to my previous videos on investment strategies, and I'm sure everything you need will be there. I'll be uploading a fresh market update video when I feel like there are meaningful things to talk about. In the meantime, I'll upload some other interesting videos to share with you guys. Thank you guys, and I wish you the best, always. Okay, so it's been a while since I covered the market, so it's probably a good time for us to refresh ourselves with the latest updates. Before we go into the details, let's recap the journey so far.
As I mentioned in my last market update video, I started this YouTube channel on November 15th, 2024, and started talking about market crisis and what causes the market to go down significantly. I also mentioned that one of the reasons I started this YouTube channel was because I somewhat sensed another interesting market environment coming, whether it's caused by geopolitical issues, excessive CPI, or just plain political issues which may be incurred given Donald Trump was starting his second term as the President of the United States. I mentioned that the market will be experiencing a meaningful downturn, as I mentioned in my recession might really be coming video, which I uploaded on December 12th, 2024. Then, in January and February, I uploaded more videos saying that we should not get excited about the market going up and should be careful with our actions given the market may act against our will. After that, I uploaded more videos giving different scenarios which may happen involving Trump and the Federal Reserve. The market was already going south from mid-February, and I uploaded a few more videos explaining why the market is going down and that we should all be careful so that we don't lose money. Now, on April 9th, I uploaded a video with the title, "My Job is Done, Last Market Update for Now." In the video, I said that, number one, the tariff situation is getting out of control, and number two, therefore, the inflation is now super vulnerable, especially in the second half of the year. And number three, Federal Reserve may seriously have to consider lowering the rates. And number four, with everything that is ongoing, valuation level has come down by around 25 to 30%, which makes the market environment relatively attractive. I also laid out best case scenario, worst case scenario, and a mixed scenario, which may happen in the market. And I also said that while the tariff situation is very difficult to assess, we should consider slowly buying into the market given the valuation is quite attractive. I also referred to my stock investing strategy for everyone video and told you guys to focus on Type B and Type C stocks. I also said that I'll stop uploading market update videos given my goal was to prevent you guys from losing money, and with all the updates I provided, I believed I achieved my goal. Now, coincidentally, a few hours after I uploaded the video, Donald Trump announced a 90-day pause on the tariffs, which lowered the tariff rates to 10% for all countries. The only exception was China, and the tariff level was increased to 145%. After the announcement, the Dow went up by almost 8%, the S&P 500 by around 10%, and the Nasdaq by around 12%. Okay, now, guys, after seeing what happened, some of you commented that I must be some kind of secret agent or a Federal Reserve official or something like that, but obviously I'm not anyone like that. My rationales of telling you to consider start buying into the market was purely based on valuation reasonings. Number one, Nasdaq was at over 20,000 in middle of February, and by April 9th, it dropped to around 15,000, meaning the index went down by over 20%. Generally, when the index goes down by more than 20%, you can assume that you have a relatively safe margin to endure the market going down further, given the market dropping by more than 20% rarely happens. And number two, as I mentioned in my previous videos, forward PE ratio of big tech stocks with decent earnings were in the range of 20 to 25 times versus 30 to 35 times a few months ago. The outlook and fundamentals of those companies were still to be seen, given the tariff was still being discussed, but the valuation levels were severely impacted to the extent where I felt like it was an overreaction from the market. Number three, political and geopolitical noise can impact the market quite severely, but generally the market recovers quite quickly after the noise becomes stale. We already experienced a similar situation in 2018 between the US and China, but that only lasted for a few months. So in short, my thesis on shifting from a be careful so that you don't lose money position to let's start buying position was quite simple. Valuation reached a relatively attractive level, but it was not caused by a fundamental crackdown on the system, but by an artificial regulation and geopolitical tensions. Now, based on what's been happening so far, the situation is quite similar to some of the scenarios I mentioned in my previous videos. On February 18th, I uploaded a video laying out 3 scenarios which may happen in the market. Those were, number 1, ignore inflation, number 2, fake blaming the Fed, and number 3, fake the tariff scenarios.
Based on what's been happening so far, the situation is kind of a mix of number 1 and number 3. We already made a conclusion that Trump is wary of the inflation and not ignoring it. But at the same time, my sense is that while Trump is aware of the inflation situation, he has more urgent things to care about, which seemingly makes him look like he's somewhat avoiding the inflation. So this scenario is somewhat relevant, although not entirely. The third scenario, which was fake the tariff, I don't think Trump is faking the tariff, but he has limited resources, which forces him to focus on a few countries which he can gain most political and financially, which is China. Okay, so enough of the recap, so let's try to assess the current situation. In order to deep dive and get a better sense of the latest situation, we need to get a better sense of why Trump is so stubborn and obsessed with this tariff. I'm sure you guys are thinking and wondering the same. I know a lot of you don't like Trump because he just seems like he's destroying the markets all over the world, but let's just put that aside for now and try to get a sense of why he's acting that way. Now, while Trump is aware that the tariff may worsen the inflation situation, he obviously looks like he's more worried about other things. So what is he worried about? Now, the US has been experiencing a twin deficit for a very long time. It started from the 1980s during the Reagan era when the US started to import more from countries like Japan and started to spend more on defense while cutting taxes. While the US economy seemingly came out of the twin deficit situation in the 1990s, the situation worsened in 2000s due to wars and the global financial crisis. And now, after the COVID pandemic, the situation is at its peak with a massive fiscal deficit and trade deficit as the US issued so much US bonds and imported so much to keep up with the demand for resources during and post the pandemic. The US's trading deficit went up as high as almost $1 trillion and fiscal deficit was at almost $1.7 trillion. So structurally, the US is experiencing a double whammy situation, and with the strong dollar in the past few years on top of what they have, they were not in a good situation. Now, based on what I said so far, the US has a lot of problems to solve. Number 1, they need to lower their trade deficit. And number 2, they need to lower their fiscal deficit. And number 3, they need to weaken the dollar to support their export. And number 4, they even need to lower the inflation which incurred from 2022. So the US was already experiencing so many problems, but now they even have more problems to solve. So Trump had some choices to make. He can either choose to focus on cooling the inflation by pressuring the Fed to increase the interest rate, expedite the quantitative tapering, but deal with their twin deficit and potential recession later on. Or he could focus on the deficits first and focus on the inflation later. We need to keep in mind that addressing the twin deficit and inflation at the same time is near impossible. The two components are very conflicting aspects of the economy, so you have to sacrifice one for the other. Now, having that said, Trump seems to be prioritizing the twin deficit and potential recession over inflation. Now, in order to address those, he had a few options. The first option he can consider was to lower the taxes to incentivize the consumers to spend more and corporates to produce more to avoid a recession. The problem of doing so, however, is that if the US government collects less taxes, it'll face even more severe fiscal deficits given the US government spending is extremely hard to reduce. Trump tried to cut spendings by implementing stuff like Doge with Elon Musk, but it didn't work out well. So Trump needed something which can address all those issues at the same time. Now, that was tariff. Now, these are the reasons why tariff can be effective for the US and the Trump administration. Number 1, tariff is the easiest way to collect taxes on all incoming goods in the US, which will be massive in the amount. The amount can only be speculated, but it will be huge to the extent it can help to resolve some of the US's twin deficits. Number 2, even if the tariff incurs some more inflation with the resolved twin deficits, Trump administration will secure room to lower the taxes. Number 3, with the lower taxes and twin deficits resolved to some extent, the US can avoid the recession to some degree. And number 4, in theory, tariff can even potentially contribute to resolving the strong dollar, given it'll make foreign goods more expensive, meaning there will be less demand for foreign currency, leading to less need to sell the US dollar. Now, if you put that all together, from Trump's perspective, tariff is the golden ticket which can send the US to the chocolate factory. It can not only resolve the trade deficit to some degree, but it can also help the US avoid a potential recession, and it can even also weaken the US dollar further to promote US's exports. The only bullet Trump needs to take is the inflation. But if he's going to take the shot, he needs to do it perfectly right. And that's why he's pressuring the Fed so much to lower the interest rate. If the Fed does not lower the interest rate, his plans can be in danger, as the US will have more difficulties in addressing the fiscal deficit, strong dollar, and recession. But the Fed is stubborn on the interest rate because the Fed's priority is always controlling the unemployment rate and inflation. So basically, Trump and the Fed had different agenda which they need to address. Now, if you understood everything up to this point, you'll now understand why Trump is so obsessed about the tariff. I believe the reason he gave the 90-day pause is because, number one, he realized that he had so limited resources to handle all the negotiation with so many countries at the same time in the world. And number two, the stock market getting destroyed is against his agenda of making the US avoid a recession. Also, Trump's only worry, aside from the inflation, is probably the major US bondholders, including China and Japan, going full force with selling the US bonds and fundamentally shutting down the US's source of income. But Trump is probably betting on the fact that the two countries won't be able to take such actions, given the US bonds take up too much of their balance sheet. Basically, if China and Japan sells the US bonds too much at the same time, it'll make significant part of their assets worthless, which is a mutual destruction scenario. Okay, so now you probably understand the motives and potential hidden agenda behind Trump and the Fed. So let's try to look at what's been going on in the market and try to get a sense of what may happen in the market. After I uploaded my last video on April 9th, the US paused all the tariff and only kept 10% base tariffs on all countries, while increasing the tariff to 145% only for China. On April 11th, China retaliated with a 125% tariff. On May 12th, however, both US and China agreed to lower the tariffs on each other to 30% and 10%. Also, the latest CPI, which was released last week, indicated a slightly cooling inflation to around 2.3%, but it's still above Fed's target of 2.0%. Now, no one really cares about CPI metrics anymore because everyone is focused on what will happen in the future due to the tariffs and not the past. So basically, the situation is that while Trump is still thinking hard about what to do to address the deficits, he realizes that too much tariff might not be good for the market sentiment. So he's trying to buy some time until he reaches certain conclusion which he can live with. Now, under this situation, how should we act? Now, if you look at the S&P and the Nasdaq, both indices were down by around 20% in early April, but bounced back quite a lot. Right now, the two indexes are down by 5% or less from the all-time highs. Price-to-earnings ratio of large tech stocks were down to around 20 to 25 times in early April, but now it's back at around 30 times. Now, as I said in my previous videos, I believed early April was the best time to start buying into the market because the valuation was at reasonable levels and the impact from geopolitical tension was seemingly at its peak. Based on where we are today, these are my assessment. Number one, I believe the tariff issue will continue to generate noise in the market and will not go away unless Trump achieves something which can address a lot of his issues at the same time. And number two, I believe the inflation will stay vulnerable for some time, especially from the second half of the year, as some tariff impacts start to get reflected on the data. And number three, major indices and key stocks are at relatively less attractive valuation, again, which makes me question whether the valuation can be justified. And number four, the Federal Reserve may react to Trump's pressure on lowering the interest rate sometime in the second half of the year, but timing still remains extremely uncertain. And number 5, corporate earnings may be impacted to some degree with the tariff and the prolonged inflation and high interest rates, which may lead to their quarterly outlook getting impacted. Now, based on my assessment, in terms of buying into the market, here's what I think. I think the most ideal time to buy into the market is now behind us. The valuation level of key stocks recovered too quickly within the last 1 month of time frame, so I would refrain from buying into the market aggressively at this point. This is because it is reasonable to believe that Trump is quite obsessed with the tariff, and any news might pop up any day, and the Federal Reserve's timing to lower the interest rate still remains quite uncertain due to relatively high inflation. However, if you think from the other side of the situation, I also do believe that the peak of geopolitical tension is now past us as well. We may face some new regulations being implemented. However, the market generally reacts more modestly on repeated news or a news which is not completely unexpected. So impact on the market may be limited than before. Now, if you put that all together, my view is that while today might not be the best time to buy into the market, I do believe there will continue to be opportunities to buy into the market as Trump and the Federal Reserve take some moves to fulfill their agenda. I want to emphasize that it is not a market where the indexes move in accordance with corporate earnings, and there are a lot of uncertainties which still linger in the market. But we still need to pay attention to the valuation of the key stocks. Each time the market moves downward due to a repeated news or some different version of the news, it may be an opportunity to buy. Also, as I said before, the market generally reacts less sensitively when the news is something which came out before. So guys, I think we now reached a point where we need to be careful again in approaching the market. But I also do want to say that there may be more opportunities upcoming which will give us short windows to buy into the market and hold for the mid to long term. So let's continue to carefully monitor the market and act with our best judgment. I hope you enjoyed the video, and I'll be back with more videos very soon.